Valuations are off the charts right now. Stocks, bonds, and real estate are at all-time record highs. This is a historical anomaly, but certainly rules can be broken sometimes. It seems as though, however, all of this rise cannot be sustained without trillions of central bank intervention. Could it be? You came here for the truth, so let me unveil that for you. Today we're going to look at those historical anomalies. I will also show you some charts and articles. Let's begin. I have a lot to cover today, so I'm going to try to move through it as quick as possible. A prolonged bull market across stocks, bonds, and credit have left a measure of average valuation at the highest since 1900. A condition at some point is going to translate into pain for investors. That's according to none other than Goldman Sachs. It has seldom been the case that equities, bonds, and credit have been similarly expensive at the same time, only in the roaring 20s and the golden 50s. All good things must come to an end. There will be a bear market eventually. So you look around the world, you look historically, what you would find is that there are different cycles. So you would have, for example, in the US, bonds rising, stocks falling, or real estate rising and stocks falling. And then you would look at the exact same time to a different country, and it may be an entirely different scenario. But since the year 2000, and I'm generalizing, of course, everything has been moving up and down together. That didn't exist prior to the year 2000. For whatever reason, everything has been moving in lockstep. They've been moving in sync with each other since that point. And it seems like as time goes on, it's actually getting worse. That isn't supposed to happen historically. As central banks cut back on their quantitative easing, pushing up the premiums, investors demand to hold longer dated bonds. Returns are likely to be lower across assets. So that's something interesting to note, and we will see how it all plays out. So we'll get onto this more. According to no less authority than the United States Treasury, projected tax revenues to fund Social Security and Medicare over the next 75 years fall 47 trillion, short. That, what they call unfunded liabilities, is impossible to ever pay back. So you have a situation where there's this impending doom, but you're not allowed to talk about it, or else you're being too negative and too critical. There are different calculations, and in this case here, the Cassandra projects America's true debt at an intergalactic $210 trillion. There are various ways to calculate it. I don't know what it is. All I know is that it's way too expensive. There's way too much there to ever pay. Of course, there's debt that exists, and all of that eventually needs to be paid back to the central bank. The central bank is not really part of the government. It is existing sort of in a quasi-government or a semi-private state, and all money comes from that central bank and has to be loaned into existence, and therefore all money must make its way back there to appease the masters. The debt time bomb that keeps growing and now equals nearly half of US GDP. There's various things in here. Basically, corporate debt, non-financial companies, you're looking at trillions. In this case here, $8.7 trillion, 45% of GDP. It's insane, the amount of debt that exists on a personal level, national level, city, state, province, region, county, corporate, doesn't matter. They're all in debt. And you look at it, you're suggesting that everything is fine today, but we're in more debt today than we were 10 years ago. There's no deleveraging that happened. Even though that needs to happen, it needs to detox. An economic detox is how I refer to it in my first book. This here, there's a lot it talks about, but I just wanted to suggest this. During the financial crisis, let's say somewhere in between these 2 points, you have all these major institutions, whether it's BlackRock, Vanguard, Fidelity, JPM, it doesn't matter. They have all increased their positions in risk as time went on. And look, $22 trillion right now. You can't explain what's happening when they suggest everything is better, but it's gotten a lot worse. There's more risk now than there ever has been. Just because the stock market has gone up doesn't make that somehow okay. Very, very strange arguments that I'm hearing from a lot of people today. We are nearing the longest 60-40 bull market without a 10% total return drawdown. The only other time this happened, look at this, 1920s. And as far as I'm considered, it will probably exceed that. All right, Janet the Felon Yellen. She said this: we don't want to cause a boom-bust condition in the economy. All right, so how about create a normal state by not printing $4.5 trillion and actually $16 trillion and keeping it on your balance sheet, and do not keep interest rates at historically low levels and allow things to restore a balance. But of course, that's not what happens. And she basically goes on here, look, we have to watch out what we do. Things are looking great out there. There's nothing to worry about, and makes everyone feel easy. You got to make the markets feel calm. All right, now let's switch gears into the actual situation, the real indicators, right? We don't want to look at PE ratios all the time. We don't want to look at anything that doesn't matter. And it's good to look at all indicators because you could piece that together for yourself. And this right here is what I consider to be a real indicator. More store closings have been announced in 2017 than any other year on record. It beats the all-time high previously of 6,000, looking at 6,700 now, and they're suggesting that next year it will be even higher. Retail apocalypse, 21 big retailers are closing their stores in 2017. If you go to this article out of Fox, it shows you those retailers and has a little description for each. Then you have this. Between 20 and 25% of American malls will close within 5 years, according to a new report from Credit Suisse. This kind of pledge would be unprecedented in the nation's history. In 1970, there were only 300 enclosed malls in the US. Now there are 1,200 of them. In fact, despite the recent turbulence in the retail industry, the number of malls has opened has actually edged higher every year. That's a big mistake, obviously. The fact, though, is that we have thousands and thousands of stores closing. We don't have one or two, or you see somehow some are doing better than others. You're just having this mass closure. A lot of people will say that's due to the rise of e-commerce, that's due to Amazon, and to some degree that's true. That has increased over the years. There is no doubt about that. However, I've shown you here on the channel before that e-commerce makes up about 9% of the total sales. So I don't think that that is necessarily accurate to suggest that that is taking away all of the business. There's something else going on. Surely, once again, I will say it again, that yes, e-commerce is pulling a lot of those businesses away to go more online instead of having brick and mortar. However, with only 9% of total sales, we're looking at this to be actually a cause of a problem economy. Okay, quickly here, the share of older millennials living with relatives is still rising, underscored by the lingering obstacles faced by Americans who enter the workforce during and after the Great Recession. So this is statistics that continue to get worse as time goes on. I've covered it before. I'll move on. This right here is talking about the situation that you have with the asset seizures that take place. So basically, somebody is apparently committing a crime. They take away their goods, whatever that might be, if computers or whatever. They take it away, they sell it, and in this case here, they received $3.25 million in bonuses in 2012. That's $550,000 more than reported previously. So steal from some people, give bonuses to others. Now, I'm not suggesting that these people who were stolen from, that was something that belonged to them or whatever. I don't know every situation, that's for sure. I just see it the way that the government is this goon squad oftentimes, and they are taking away through taxation, through, whatever this asset seizures, many different situations. They take it away from us, and they use it how they may. In this case, CEO bonuses or executive bonuses. And you'll see that in the big banks, how they got big bonuses for themselves. And you just see basically that so-called 1% seems to be getting more and more of the wealth. The average person, unfortunately, gets the short end of the stick as usual. So that's all for this video. If you found it informative, please give me a thumbs up. That truly does help me out a lot. So I appreciate that. I just want to thank each and every one of those individuals out there who support me, whether that is simply from giving me thumbs up, commenting, and subscribing to the YouTube channel, or all of those who donate to me through PayPal, through Patreon, through all of the cryptocurrencies, and anything else, buying my books, of course. I do appreciate that very much. Thank you, each and every one of you. Okay, last but not least, if you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. If you want to look through them, links are in the description below. Take care.